is made possible by Robinhood. Try out Robinhood Legend, the all-new free desktop trading platform designed for sophisticated traders like you. While there is no cost to use the Legend platform, there are other fees associated with your brokerage account. See the Robinhood Financial Fee Schedule for more information. Tuesday, September 23rd, 11 a.m. on the East Coast. Going to throw you a bit of a curveball today. Typically, Dan, if it's Wednesday, it's, yes, Butters. But you know what? We're doing it on a Tuesday because why not? Want to try to slip an Uncle Charlie by you. How are you, Dan?
I'm doing great. What is an Uncle Charlie? I mean, do I have
to go to
the Urban Dictionary for that one?
No.
Hey, by the way, I see this. I read the Wall Street Journal every morning.
WSJ.
I don't actually read the paper. I kind of read it on the line. Yeah, Bill's like, ooh. I flipped through it. And there was an article this morning about Indiana Jones. That's what he's being
Daniel
called.
Jones, yes.
Daniel Jones, the 3-0 Daniel Jones versus his old squad, which is 0-3.
Yeah, he was on the Manning cast last night. He could not have been more boring.
Oh, really?
Yeah, Bill.
Oh, now you've turned on him?
No.
It sounds like you have.
No. It's,
and by the way,
no. Let's be crystal clear.
Isn't Eli the most boring man in all of sports?
Eli and Peyton together are pretty amusing. I mean, Daniel Jones has always been boring. I never said he was Don Rickles. What I did say, though, was he had ability and he could play in this league, and that is obviously bearing itself out on the first 3 weeks of the season. Now, we'll see if this is just a bit of a mirage, as they say. I don't think that it is. I always thought he had talent, but I digress. But I like what you did there. Now they're calling him Indiana Jones.
I didn't do it. I just read it in the Wall Street Journal because I read
By the way, Amanda, sorry. Amanda is great.
He's doing great. All right, so we have Butters.
Hold on. Yeah, but I want to you mentioned back in the day when I would take the train in from Croton on the Hudson, you'd see a lot of business, mostly men, but business people reading the different newspapers. And some of these cats would wear gloves because they didn't want to get the ink from the paper on their fingers. That's
a Johnson move. All right. They're the same people
who
used to wear what are those things you put on your wingtips? You see those folks walking
rubbers.
What?
You heard me.
All right, they used to put these rubber things on the bottom of their leather. I don't even know. Like, that is the most ridiculous thing I've ever heard. All right, so we're going to do Butters. We're actually going to do 2 trades on the Legend today, guy. One, we're going to use Carter's charts. Carter Braxtonworth of Worth Charting. He did some great work yesterday on the Russell 2000 on the IWM, the ETF that tracks it. And then we tease. There's something going on in Oracle here, guy. This story bugs the crap out of me. I've been talking about a gap fill. I think we're going to play it in options, playing for a gap fill back towards that 250.
Yeah, that's big today, but yes.
So what do you want to start with here? I mean, I look at, this churn that we're seeing yesterday. It seems like every day, man, there's a new story or new headline about these guys paying that $10 billion for this. This data build's going to do this, that, that was the driver yesterday.
Yeah.
It seems like things have flip-flopped a little bit today, guys.
That's what I think we should start with. And, it dawned on me when I saw the NVIDIA announcement with John Fort yesterday, $100 billion announcement. And, there's a term called vendor financing, and Doug wrote a piece about it. And it's what I thought of immediately as well. And that's basically when the people or the group that sells something gives money to the people that buy so they can buy that something from said group. I mean, it's I don't want to say it's entirely fugazi, but it obviously is not, to me, it doesn't pass the sniff test. So here's basically NVIDIA going to invest $100 billion. So basically they can buy their chips. It just doesn't feel right. And I think you know this a lot better than I do, but I think there are 5 or 6 companies that represent close to 70% of NVIDIA's revenue stream. And, it just doesn't make a lot of sense to me. Now, with that said, the move yesterday in NVIDIA made 0 sense to me, unless you want to say this is just a prelude of things to come. But, that to me, the move yesterday on the volume that we saw, and then across a swath of stocks, that reeks of sort of crescendo, in my opinion.
Yeah, and there's another thing, and I'll put this in the chat, and these guys can kind of scroll through an article from the information. So your point about OpenAI investing or getting $100 billion investment from NVIDIA. The initial payment's going to be $10 billion to help them build out a data center. OpenAI has actually been spending tens of billions of dollars in contracts, right, with Oracle to build out data centers. So look at what's going on here. NVIDIA is investing in OpenAI so they can buy NVIDIA's chips. OpenAI, okay, is doing deals with like SoftBank and Oracle and others, right? So there's this kind of, and Microsoft invested in OpenAI to get their technology, and they were basically getting credits towards Microsoft Azure's cloud. That's a data center. So all this stuff's going on, and then now, because these balance sheets, while they're fantastic for these big hyperscalers, they're spending 25, maybe 30% of their revenue. Sooner or later, they're not going to be able to keep up, right? Because they're spending hundreds of billions of dollars of the build outs of these data centers. And if you don't start seeing, and there's an article in the FT about it, it goes back to that MIT report from a few weeks ago. If you don't have corporations seeing the benefit of this technology and the slowdown in the use of this compute, which actually really hasn't kept up at all with the pace of the build out of the hyperscalers or the data centers. So now you have a situation where who's financing this, right? Yep. So I want to take you to an article from the information. I'm just going to put it in our chat really quickly. And I'm also going to find that FT article. So now it's private equity, right? Now it's basically all these different funding sources, right, are going to have to kind of flip the bill for this. And if you just think about what's going on in here, this is the important part. So Morgan Stanley is projecting $2.9 trillion will be spent on data centers and chips through 2028. Okay. The big chunk, $1.4 trillion, will come from the cash-rich tech giants. Of the remainder, Morgan Stanley says $1.2 trillion will come via debt. This is with private credit funds, okay? And so when you think about like the transparency in private credit, right, relative to what the banks can provide in public debt and the like, I mean, there's just some funky stuff going on here, man, that like it just feels like if there is just a slowdown in demand, well, NVIDIA is going to feel it. And then all the investments that NVIDIA has made, not just Intel, OpenAI, and then about 100 other private startups, you're just starting to feel like there's literally systemic risk throughout the system, not just in technology, but not just in the banking system, but also in what you would call the shadow banking system.
Yeah. And Gene Munster actually made, you're on with Gene a lot on the different podcasts. And I think he made sort of that point yesterday. And, I think one of the things that he said, though, is
wait, hold on. He didn't make a point about the risks of it. And I love Gene. We're good friends. I actually made the point when he was done talking, Guy. Mm-hmm. And my view is that there's all of these really bullish folks who see from A to Z, and Z is basically 2035. Okay. And none of the bulls for a moment conceive of this idea of a slowdown and what that might mean for the entire ecosystem.
Yeah. Fair enough. So in response to your point, then, he said that that's obviously the downside of this. And, when the downside happens, it's going to be precipitous. And, that's really the rub, right? When does this all start to play out? Because the more these headlines that we get, the more emboldened people become. But, to me, it just feels like, and I'll use the term, a bit of a shell game now. They're just sort of moving things around the board and they're not really accomplishing all that much. So, we'll see. I think the price action yesterday didn't make a lot of sense to me. Today's sort of sell-off does. And is yesterday going to be, again, to use the term, sort of the crescendo in terms of the stock performance for the remainder of the year? That remains to be seen. I remain in that camp, though.
Yeah, and so just my 2 cents on this is like, if everyone wants to focus on NVIDIA, right, you can focus on OpenAI, but it's a private company and the disclosures are somewhat limited, except for the fact that they keep making eye-popping headlines about, compute and need for energy, and the list goes on and on and on, okay? This article in the FT, and we'll put it in the show notes, I think is really interesting too, because it's also talking about a lot of these ancillary plays, you know what I mean, of how companies are using AI. And for the most part, it's within their own businesses, not in their ability to resell it or not in their ability to kind of use it and then basically upsell existing clients or the like, or customers. So that is what it is. There's a couple great quotes in there. It's like really a lot of this investment is coming out of FOMO rather than, legitimate use cases. Mm-hmm. at the time. You and I agree. This is technology, just like the internet, that is going to transform so many different businesses. Who knows what it does for the economy in the near term? But we can all say that the internet, 25 years ago, 30 years ago, there were a lot of folks who believed that it was going to transform the economy, but it took a long time to do it, A, and B, there was hundreds of billions of dollars of investment that went poof, right? And you could say, well, Amazon, all these guys are trillion-dollar market cap companies. That's fine, but it was kind of like a winner take all, if you will, if you just think of it. So here's what it is. I think Oracle is going to be a company that has made a lot of promises they're not going to be able to deliver on. I don't know how they can keep booking these contracts if they don't have the infrastructure built and they don't have the capital to do it. Okay. So let's look at Oracle for a second, Guy. I want to get your take on this gap. Let me go and I'll drive on the legend here for a second here. Okay. So let's just go to this chart here. And so what I have here, let's just go, this is a 1 year right here. You see that massive gap. We had that a couple weeks ago. That was on that guidance that they gave, OpenAI, big contract, yada, yada. It's been kind of running around a little bit. I just want to go to a 1 week, Guy, because if you just look at the volatility that we had yesterday, it really looked like it was breaking out of this 1.5 week range or something like that. And then I think cooler heads sort of prevail. And they're like, wait, why did we run up Oracle 5-6% or something like that off this NVIDIA news, investing in OpenAI? Because OpenAI gave Oracle a contract. All of it's on the come. Okay, so talk to me about this gap and then this consolidation and then reversal today.
I looked at the move the other day when it had that huge gap higher, and I said, okay, we've seen this before. We talked about it. We saw it with Microsoft to a certain extent. We clearly saw it with Broadcom last December. And I thought to myself, right, again, that's just sort of people, you use the term FOMO, but that's just people piling in because they almost were forced to. But they were piling in on a revenue guide. And again, to talk about it, the earnings on that revenue are still yet to be determined. And what's happened right before our eyes in terms of Oracle, it's going from a relatively fair valued stock to a relatively expensive stock in a very short period of time. This is probably as expensive as Oracle's been. I don't want to say in its history because I can't go back that far, but I dare say probably since the late 90s, early 2000s. And it just, to me, doesn't make a lot of sense. So this was a company I loved for a long time, as you know, but it's very hard for me to get my arms around it here at these levels and these valuations.
Yeah, there's an article in the information the other day. There it is, the magical thinking behind Oracle's valuation. Guy, I know you didn't read it. I'm not giving you shit for not reading it, but
no, I love the information.
No, but what I'm saying is exactly what you just said. They just spilled, 500 words on, and they gave lots of different examples of kind of the magical thinking behind this. So we'll put that in the show notes too. All right, so let's go back to the legend here. So you just talked about that gap. I look at that, Guy, and I say, you know what? It did a good job of kind of getting into that gap for the 2 days after it. And then you saw that sort of consolidation. So I look at the level of about $300, if you can kind of see my cursor here. And then I'm going to go down to the gap, and I can say that's about 240 or so. Okay. Mm-hmm. So if I wanted to kind of isolate that range over the next couple of months, okay, I can look out, my puts, I'm not shorting the stock here because the way that this price action, the way of the announcements, maybe we're in this kind of like, blow off sort of phase, Guy, into year end where they take all these. So I want to define my risk. Okay. So I think I want to look out to the end of earnings period, which could get you through mid-November or something like that for Q3 earnings. So let me go to the options chain for a second here. So I'm going to November expiration, and let's just say I want to target that $300 to $250 range. Okay. So if I go to the at the money, that's 310 or so. Let's say I want to look down a little bit. So the 300 put in November expiration costs you about $19. That seems a bit aggressive here. But if I want to target that kind of 250 level, because that was also the breakout here. So let's just say the 300 250 put spread in November expiration. So that's November 21st. That would cost me $14.30. So if I'm paying $14.30 for, it's a little less than, let's say, 30% of the width. That's not a good risk reward. But let's just say I want to double that up and I want to sell 2 of those 250. Okay. So then I have a 1x2, and then I'm going to look down to that 200 strike, and I'm going to put what's called a butterfly. So I'm buying one of the 300s. I'm selling 2 of the 250s, okay, and then I'm buying one of the 100s. Why am I doing that? I'm creating a range here between 300 and 200. So now if this costs me, let's call it just $10, just for like round numbers here, okay? The 300, 250, 200 put butterfly. I'm spending $10. That is my max risk. I break even down at 290. I have gains of up to $40 between 290 and 250. 250 is the range that I'm targeting. If the stock closed at 250 on November expiration, I'd make $40. But then let's look to the downside. Let's say it overshoots that 250 level. I still have gains of $40 from 250, okay, down to 210 because I paid $10, okay, and that 210 to $200, I would lose up to $10. Below 200, I lose $10. So think about this range. The stock's at 310, between 300 and 250. I paid 1,000. I can make $40. Okay, like I like that risk reward. And what is $10 on a $300 stock? I'm risking a few percent of the underlying. What do you think of the ranges here? The trade structure, it's not for everybody, but the way I just laid it out, it's actually, if you're looking at the trade ticket here, I'm buying the 300, I'm selling two 250s, and I'm buying one of the 200s. I'm risking about 10 to possibly make 40 between basically 290 and 210, guy.
Yeah, makes sense. I mean, 4-to-1 you'll do. I mean, I think minimum you want to be sort of 2.5, 3. You're at 4-to-1. I think the range is, listen, it's wide, obviously, but it's wide for a reason because just of the movement of the stock over the last few months. So it's not ridiculous to think, we can't sort of do a back and fill to some of these levels. It's complicated, but it if you think about it, what you've done is you've defined your risk really well, and you've set up a situation where you're looking at, again, a 4-to-1 risk reward in your favor. So I like it. I also think you potentially could be setting up for a bit of an island reversal here in Oracle if things sort of pan out the way I've thought they're going to pan out for quite some time. I do think the market's gotten really ahead of itself. Now, there were a lot of analyst upgrades in the wake of what we heard last week or 2 weeks ago, whenever it was. I get it, but I think people are chasing at this point.
Yeah, I agree. So, all right, that's our trade. We're looking at November expiration. We put the 300, 250, 200 put butterfly on. It cost us a little more than $10. That is our max risk, and we have the potential to make, $40 ish between 290 and 210. We have a max loss of $10. Basically below 200 and above 300. I like the risk reward here, guy. That is our trade on the Oracle. Do you want to go to
I got
Carter?
Some questions. We can go to Carter, but I want to do it because I want to get to these real quick.
Yeah.
Somebody's asking about IONQ, and it's funny. This is a name that we talked about, I think, last week. And I think the CEO, and please don't at me, but Amanda or Jacob or Timmy or Bill or anybody, CC, can pull up the comments he made. He basically, in talking about NVIDIA, said that, they will be competing with NVIDIA sometime, I think, in 2026, 2027. And he said Blackwell, and now I'm almost quoting, is a joke. And IONQ sort of went ballistic on the back of some of those comments. I think the stock has basically doubled-ish since August. And the question we have, is it time to short some IONQ again? Look, I don't know if you just said it. I mean, shorting things in this environment is not a great play, but if you've been long the stock, God bless, but it's definitely time to take some money off the table because this has gotten itself very expensive very quickly.
Yeah, this is a $24 billion market cap company. The company has never made money on a GAAP basis. They're expected to lose $1.77, $1.84, $1.69. These are all over the next few years, $1.09 in 2028.
Yeah.
And so on expected revenue,
about $170 million. Now, granted, it's probably, they probably have year-over-year revenue growth of, 75, 80%. So, but the question is it justified these valuations? I don't think that's just me, but so there you go.
Well, I mean, it's, if you're chasing some of these sorts of names, right, at this stage of the game, it just seems like this is a bit of FOMO. This looks like people looking for opportunities to kind of play a theme. And especially if you're coming at the king, you best not miss, guy.
Was that a song?
It
sounds like a Beastie Boys lyric. Those guys that wore the hat crooked.
What do you say often? I mean, this is a stock that was trading single digits a year ago.
Oh no, I know this.
74.
This time last year was a $7 stock, I think.
Yeah. Let's just look. Some of the things I like to look at. I'll go look at the holders. So Vanguard, Morgan Stanley, BlackRock. So it's all it's in these index funds. But then there's NEA Management. This is a very good VC fund. It must have been a distribution. They're still in it as of 11/16/2025. So that's last year. Alphabet is a shareholder. So this must have been a VC-backed company. Interesting. I don't know. We'll take a closer look. What do you got there? A Squawk Box.
Yeah, it was their 30. I just did that to annoy you.
It was that 30-year anniversary, like a week or two ago, wasn't it?
Yeah,
it was. They had like a big thing on the show.
Yeah, my invite got lost.
For what? To the show? You've been on Squawk Box.
I've been a co-host from time to time. Yeah, I mean, not a co-host.
Oh, did you go to the celebration?
I wasn't invited.
What do you mean you weren't invited? You're like Guy Adami, CNBC's Guy Adami.
I mean, do you want me to put it in? You want me to say it with a different dramatic, like intonation? I wasn't invited. How's that?
That's
Same
weird.
words.
Honestly,
unless that's more meaning.
I didn't know that. I knew there was an event. I knew
Warren Buffett was there. They probably had to vet people.
Warren Buffett was there.
Sure.
Really? Who else? Yeah. Like, were there a lot of famous people like that?
I think he might have been, in terms of the famous people, I think he's probably at the top of the list, but I think it was that type of ilk.
Yeah.
Anyway, sorry. I apologize. I didn't mean to get
this from, there's a question. This is right in your wheelhouse.
UPS, I bet.
No, it's on gold. This is from Zaid Khalaf. Zaid Khalaf. So he's saying, guys, what do you do with gold and especially silver? It just keeps going up. There's worse problems to have.
I was going to say,
did you see there was an article in Bloomberg Guy about the Chinese gold reserves? They just keep doing what you've been talking about for a while here.
Years we've been talking about. I mean, I am wrong a lot, but this is one that we've been talking about now, and we've been spelling it out, like all these things, like we've been paying attention to all these things. Now, all of a sudden, what do they call it? The mainstream media. Now they're starting to pick up on
the lame screen,
whatever, which is a little disconcerting, but I don't think it changes the story at all. And yeah, it just keeps going up. And now the gold miners finally have caught up to it and are participating in this. And yes, now silver is participating in this. And I think embedded in this question is, my God, I can't believe we've been so, you have been so successful with this trade, Zayad. What do you do right now? All right, if you want to play a little stock market, a little commodities trading, take some money off the table if you're uncomfortable, if you think this thing is going to, derail at some point. This has been my commentary, and until something changes, will continue to be. I don't see what's going to derail this right now. And everything continues to point to gold working, and it's across a swath of different things, and it's telling a story. Even that news with the United States and Argentina yesterday speaks to the importance of gold, and I can back into that. But again, more and more things are happening around the world. All roads lead back to gold, now silver. So I just say stay with it. I know that doesn't seem logical because of the move that's had, but I think you got to stay the course.
There you go. This is one though.
Every day. I mean, it's every freaking day.
Yeah. This is, these charts, they trade, a lot of the trading is very technical, right? The way folks look to kind of breakouts and where they put their stops and the like. And I just think, to your point, there's just some fundamental demand for it, which, this is not exactly my jam, but you've been all over it and you've been very right. And,
and you know what Amanda just said? What? On the legend, you can show futures on the legend.
Yeah, they trade futures. You actually short stocks, and you can trade the heck out of the options. Let's go to Carter's work on the Russell 2000. And so, he does obviously extraordinary work, as you might say, Guy, and his service, worth charting. He comes out with these sorts of reports multiple times a day. He does a daily video. So he had something. He's going to be on with us tomorrow on the market call, but we just kind of wanted to highlight this here today. So, you see that going back to the all-time highs in 21. We've highlighted this. Yes, last year or earlier this year, it gets rejected at that prior high. Here we are, V reversal. Let's just go to the next two charts, Guy, and we're going to kind of, maybe we'll ask the folks in the chat to kind of give us. So you see that That's not his suggestion. That's just one way to look at it. And then you can look at the other way, guy, and you see that. And so really, this is where it comes down to, what is your overall thoughts about the macro? What are your overall thoughts about small companies here in the US? We've seen some data weakening. We've seen some of the jobs data. We know that small companies are 2/3 of the hiring. Like there's a whole host of things you could say. What do rates mean for it? All that sort of stuff. So, Guy, thoughts on small caps here? I know that you and Liz talked about it yesterday in the Risk Reversal podcast, which dropped in your favorite podcast store this morning. Where are you on this?
Well, I mean, understanding that the majority of these names are small and regional banks, so you put that out there, and obviously the move we've seen in small and regional banks. But part of your question is this justified? Now, whether it's justified or not, to me, it probably is not the point. But here we are. But what do you do in the here and now? I don't think the macro is particularly solid or provides a tailwind for these names. Quite the opposite. The employment picture is deteriorating. The rate picture is yet unclear, despite the fact that the Fed cut last week. And, just some of the soft data now turning into hard data suggests that things are slowing down. So none of these, again, are tailwinds for these small and mid-cap stocks. So I understand what's driving it. There's this want for things to improve, and there's this belief that lower rates will somehow be a salve for these small and mid-cap names. But you also have to have an economy that's behaving itself and providing support for these names, and it's just not there. So if you're asking me to pick which you are, I'll take the down arrow for 500 before I take the up arrow.
There you go. All right. Well, that was obviously a nice little fundamental view of that, and obviously from a macro standpoint. But if you also want to just kind of, like you said, look at some of the companies that make up that index. This is the ETF that tracks it. All right, let's go to the legend here, because I just want to kind of look at it from our perspective, Guy, the way I'm seeing it. So this is right here. This is a year-to-date chart, right? And I'm just going to show you how I might consider charting this bad boy. All right, so you see this here. Let's go to actually a 1 year. You see exactly what Carter sees. Okay, so you see this sort of V sort of situation. Let me just kind of show you how I might do this here. And if I go here, and you can just kind of look at this line right there, we're right up against it, right? That's what Carter was telling us. Okay, so now let's go to the 5 year, and that's where you get that sort of triple top, right? And so if we want to do this here, we could do the solid line, we go over here, it is what it is. Okay, so if I look at this and I say, all right, let's go to the IV, let's go to the implied volatility of this thing, and I'm going to look at a 1 year basis. You see that it's come down fairly dramatically. You did have that absolute crush this summer. That might have been around, I think, one of those triple witching sort of thing. So it's not likely the price of options to go too much lower here, especially if you have a stock that's kind of moving the way it has been. It's just kind of been, little bit here every day. You did have that one big move 3 or 4 days ago. So let's go to the options change for a second. We're making the assessment that from a technical perspective, we think that that triple top, it's not the one to be broken out of. You just gave us our fundamental view, especially with a bunch of the data. The options market is basically saying, you know what? To buy premium here there's been far worse times over the last year, right? So if we're looking at that sort of 246 level where the ETF is trading, and we kind of identified, let me just go back to the chart for a second, Guy, would you be looking at this sort of breakout level down at this kind of, this is about 225, 226. Okay, so we're at 246. Do you think isolating a $20 range in the near term makes some sense for an options trade?
Yeah, I do. I think, the logical level to me, again, you're up against levels from the fall of 2021. You just showed us where we were in December of last year. So however many months ago that was, 8 or 9 months or so ago. What's the next level? Well, it would make sense that it's a level that we sort of took off from in the early August, which was about 215. So that's a little bit lower than you have flagged, but that's exactly right. Somewhere between 215 and 220 makes a lot of sense.
All right. So the $20 wide in October, 245, 225 cost you about $4. So risking 4 to possibly make 16 if the ETF is down at 225. Do you think we have enough time between now and October expiration? So that's October 17th. And then you also have to think about what are some of the things we're going to get between now and then, right? So we're going to have
PCE, the Fed's preferred measure.
we're going to have CPI and PPI. We're going to get into some of the bank earnings and the like here. Or do you want to look out to November expiration? And let me just go over there and we can.
It's obviously going to cost a little bit more. I mean, the risk profile sets up a little bit differently. The reality is, I think with a month that you're playing for, I think there's enough time. So I think my instincts suggest we're not going to meander around these levels. We're either going to go blowing through it and be trading 260 next week, which I don't think is going to happen, or we're going to stall out here and we're going to start the back and fill. And I think that's going to happen over the next week or so. So I don't think time is as important right now as just sort of the directional play. So obviously November gives you more time. So theoretically, more ability to make good, but it also is probably going to cost a lot more as well.
Well, all right. So we're $4 a knock, same 20 wide versus $5 a Nov. Okay. And the way I think about
terrible, actually.
Yeah, I'd probably rather do November. Now the other thing is the downside put, the 225 put that you'd be selling in October was less than 1%. Not a good sale. You probably would say, let's leg into this thing. Let's give it a shot in the October. Let's just go back to that for 1 second. I don't want to get too much in the weeds here, but I'm just going to give you a sense of how we think about this. So the October, we just said the 245 would cost about 450. And then if you go down to that 225, it's not a great sale at about 57 cents. Okay. So maybe you would just kind of buy that 245. I just don't love the idea in this environment, just sitting there with some premium, but 457 in October, that's what it would cost here. Let's go back to November. And if you were just going to go buy that November 245 put and you do the math here, it is 734. Let's look at November. I just think this makes more sense. We'll look down at that 225 strike. So that put spread $20 wide. It costs you about $5. Yeah. So I don't know, let's make it 515. That's what we're going to do here. And we will do this. Let's just put it in there. So let's submit that. We'll put that in there. We'll leave it in there. It's filled at 515.
That's like
that on November 245, 225. Let's call it $5 there. We risk 5 to possibly make 15 between now and November expiration. All right, we did that, guy. Where do you want to hit? What else do we got?
Locked in. Well, I mean, I think, but we have Carter's chart, so we saw that. I think it makes sense. Listen, giving yourself time is always advantageous, I think. But I will tell you, I think you're going to know within a week and a half or so if this thing is working in your direction. So that's just my 2 cents. But listen, I totally get why you'd want to do November. Real quick, Doug Cass has been sending us something, and I just want to, throw it up. This is via Doug Cass and Helene Meisler. Just take a look at Amazon yesterday, to the extent that it even matters. But you're getting a lot of weird price action in some of these larger cap names, and Doug wanted to highlight that. That stock obviously down a couple percent today. I don't know necessarily on what, but we traded to levels that we saw in January. We just traded up to there, I think, over the last couple of days. Yeah, and seemingly it's sort of giving it back a little bit. So that's something to watch.
Yeah, and we've been talking about this, and I like the fact that Doug's highlighting and Helene's highlighting. You've seen this kind of churn, right, within the Mag 7, Faithful 8, top 10, whatever you want to call them. And so, there's been a bit of a trade-off, right? Microsoft, we've talked about Meta. They kind of got stuck in the mud. You saw money going to Google. You saw Amazon take a shot at those prior highs, but obviously Helene's chart work is saying it was rejected there, right? And NVIDIA just closed a new all-time high. It's coming back in. So the idea that money back into NVIDIA, $4.4 trillion market cap company, is sucking it out of some other areas, but then you're seeing a bit of rotation. So keep an eye on some of these big names at these kind of, uptrend support levels, whatever you want to call them. And then the other thing that Doug made this point yesterday, he was talking about advanced decline. By contrast, he said NVIDIA, Apple, and Oracle. Apple is the other one that saw a lot of money move back into it over the last 2 weeks or so, accounted for 42% of the S&P advance. That was yesterday. So again, all worth keeping an eye on. Guy, if it is Tuesday, it usually is not. It usually is not. But it's Tuesday. It's a special Tuesday. Do you want to get us into this here?
Well, John Butters is the senior earnings analyst at FactSet. He provides us access to his work a priori, as they say, ahead of time. And we were allowed to share it with our audience. I think you all know what I think of Mr. Butters. I know what Dan thinks of him. We've been reading his work for quite some time. And, this is how you get it. FactSet.com/insight/subscribe. Not as confusing as SoFi, but very few things are. But there you go. You get it in your inbox.
Right. So every Friday morning, the Earnings Insight blog by John Butters, he's the senior earnings insight analyst over there at Facts.
No, he's not the senior earnings insight analyst.
I can never do this.
Earnings analyst.
All right. So John Butters writes the Earnings Insight blog. It drops Friday mornings in your inbox. You can get it at factset.com/insight/subscribe. John is the senior earnings analyst over there at FactSet. So we get a preview of his note. Here we are, guy. This is an interesting one, especially as we've seen lots of price action in the major indices. We've seen strategists chasing their tails all year long. They got really geeked up as we were in January, February. The whole idea of, this kind of pro business agenda by the new administration just had stocks soaring, right? A lot of optimism. And then the rollout of the tariff policy, you saw stocks just crater, and you saw analysts going all the way down, guy, right? They were just kind of ratcheting down. So they've come back up here. So the bottoms up target price for the S&P 500 is 73.38. Based on this number, industry analysts believe the index will see a 9.6% increase versus Monday's close over the next 12 months, Guy Adami.
And this is not unlike what we've seen historically. I mean, this ratio or this, pattern has been pretty much in place outside of a couple sort of significant drops in the market. So this is playing out right before our eyes, as it historically does. But what it speaks to is, the continued optimism amongst the analyst community and, their willingness, again, to pay a premium for a dollar's worth of earnings. And, that's what we're really seeing. Yes, earnings have been better. But I would say, and I can't do this in my head, but I would willing to bet that 65 to 70% of the rally we've seen over the last 6 months is multiple expansion. And the other, either 35 or 30%, is earnings growth. And I just don't think that's a healthy balance. But that's what we're looking at in this chart specifically.
Yeah. And so this is one that we've been kind of stuck on a little bit. So let's go to the next one here. So this is at the sector level, and we've seen this routinely. And it seems like maybe analyst strategists have not kind of caught up to the fact that some of these areas to the left of this bar chart, the expectations are still really high. So at the sector level, the energy sector up 14.6% and consumer staples up 14.6%. Sectors are expected to see the largest price increases. Okay, so these are two sectors that act horribly. Like if you've seen some of these staples, like Colgate just fell off a cliff, Procter's acted really heavy, that sort of thing. On the other hand, the communication services up 5%. Sector is expected to see the smallest price increases. So speak to me a little bit about that, because this is a phenomenon we've been talking about, because communication services, we know the names in there, they've been a huge part of the price increases because of the concentration, but now those expectations are much lower. And then the worst acting groups, energy and staples, now have the largest expectations for pricing.
So you can actually make an argument that this is sort of the inverse of what we typically see with sectors where communication services and consumer discretionary and financials are at the top of the list, and this time at the bottom of the list. But that actually could be encouraging, because those are the ones that have actually outperformed on a pretty consistent basis. So maybe the fact that we're seeing, diminished expectations is going to work to the benefit of the three groups that have been driving the market in the first place, because it's clear that energy and consumer staples, and to a certain extent real estate, are not pulling their own weight.
Yeah, no doubt. Let's just okay. Well, thanks, John Butters, for that. If you want this Earnings Insight blog in your email box on Friday morning, go to factset.com/insight/subscribe. Guys, let's just pull up Colgate for a second. Then we're going to get to
Procter & Gamble's even better, because you mentioned it. Procter & Gamble, I think, made an all-time high in November, last November. And since November, and then that's approaching not a year, but let's call it 10 months. I mean, there is not a bounce in this name, and it is a series of lower highs and lower lows, and we're about to do it again. So I don't know this is what I think is going on. That run up into November was their ability to pass prices on to the consumer, and the subsequent sell-off is their ability not to do so. They can no longer raise prices, so their margins have been degraded. And I think that's sort of a cautionary tale here, Dan.
Yeah. So do you think with kind of low single digits expected earnings growth and low single digits expected sales growth, you talked about margins and the pressure they're going to have, and this is one that Are they a beneficiary of inflation? Or are they not? These are consumer staples. Ultimately, we've been talking about a trade down that's been going on. We've seen what's happened in the restaurant stocks. So some of the more food oriented ones should be benefiting. They're not. But, Procter's trading at like basically a market multiple of 21.5 times, which is not something it generally trades at,
No.
And so when you think about the dividend yield in some of these things, they've been moving a little bit higher, 2.8% Procter. There's no reason to kind of own it, but these things look like kind of corporate bonds or, investment grade bonds.
Well, you just said it though. Look, they're going to do probably $87 billion of revenue this year. I think they report on October 24th. Maybe they'll do $90 billion next year. You can do that earnings growth. It's not robust. Revenue growth, excuse me. Earnings growth, maybe 8%. I'm doing that off the top of my head. You probably have it in front of you. I mean, does that justify the multiple that it's trading? I don't think so. And I think the market's finally figured that out. And, this stock was lower left, upper right as they were able to pass on the cost to the consumer. And it's been upper left, lower right as they've been unable to do so. So to your point, inflation works for these companies until it doesn't. And that's not me trying to be cute. I mean, that's just the way these things work out.
Yeah. Let's talk about Kenvue for a second. So this is one, it was your final trade yesterday. Doug detailed how he bought it on thestreetpro.com yesterday. So you know what they say about brilliant minds. Stock got nailed, but again, it was already on its way down. You know what I mean? Prior to this, for the reasons that I think a lot of staples were, that was a huge breakdown, right? Big head and shoulders top, if you just see that. So the administration comes out, they say, women who take Tylenol while they're pregnant increases the odds of autism. I don't know if there was a lot of data that supports that. We had a guest on Fast Money last night who disagreed with that. I know it's going to go both ways depending upon how you think about science. But the stock got nailed. It's bounced a little bit today. I think some of those, fears or kind of the worst takes on that have been rebuffed a little bit here. What do you do with this? I mean, obviously you thought that it got overdone. This now has, with the price decrease of 4.75% dividend yield. And let's just say it comes out that folks don't kind of believe that Tylenol is this sort of threat to mothers who are pregnant and the potential for autism. Thoughts here?
Yeah. Well, again, I think I clearly understand what's happening with the stock. It's sell first, ask questions later, but this would be devastating if this was a complete sort of rebuke of Tylenol for everybody on the planet, but that's not what it is. And the stock was trading like it was. And I think as cooler heads prevail, people realize, well, wait a second, we're selling something down to levels that doesn't really make a lot of sense. So when the market basically grasps the fact that, okay, this isn't sort of the death knell for Tylenol specifically, I think this is a stock, in my opinion, that can levitate right back to levels that we broke down from. And if you go back and look, it's, maybe low 20s, like 21 or so, which we saw late August, early September. Now, percentage-wise, that's a pretty big move, and I think that's what you're trading for right here.
Yeah. Not one that I can really comment on. I don't know much about these sorts of stocks, as you know, Guy Adami. But again, from a trading perspective, and this might be one that actually looks interesting to use options to kind of maybe play with defined risk to the upside. You see that 200-day moving average all the way there. It'd probably be at that breakdown level in the not too distant future. Maybe that would be your target to the upside. All right. Did we cover a lot of ground here today?
We did. We typically do. Butters, it's always great to have John Butters on a Tuesday. My God. For you, I shouldn't even. No, I'm not even going to go there. Yankees play the White Sox at home, 3-game set. So there's still a chance that the Yankees, listen, it looks like if you're doing the math, it looks like the Yankees need to run the table. In other words, win the remainder of their games 6. And the Toronto Blue Jays would go 3-3, which would make the Yankees a division champs. The Toronto Blue Jays have the tiebreaker. So if they were to end in a tie, Toronto wins the division. I also enjoyed what the Detroit Lions did last night. That, by the way, Dan, could be a preview of next year's Super Bowl, but this season's Super Bowl. So keep an eye on that.
Yeah. Really quickly, Guy, Amanda just put this in our little chat here. Micron reports after the close.
They do. Yeah. It's had a huge move.
So the implied move is about $17. So about 10%.
10%.
So is this an all-time high in
Yeah, it
micro?
is. This has been a parabolic move since, if you look at since August, I think this stock is up 65% since the begin. I think since don't at me if I'm
of the
off.
year.
Beginning of August.
Yeah, it's 100% of the year. From
Yep.
the April lows, it's up 175%. 10% move, you say, well, that's a lot, but if you just look at the at the money call or the put, it's about 5%. You know what I mean?
Yeah.
And so this is a stock that is gonna move. I mean, there's no way to think about it. I don't know if it's gonna move 10%. I don't know if it's gonna move.
Know this Merle. I don't know what he does. Yeah.
I don't know how he earns a living. But last quarter, by the way, guy, in June, I just said emphatically how much the stock's gonna move. It actually moved 1%. Which is kind of insane. Go to a 1 year or year-to-date chart if you don't mind here on the legend. Sometimes you don't have to do anything, but like if you just kind of look at this thing, think about the guide, the beat and raise that they're going to need to put up to keep this move going. This is a stock that let's just kind of look at from a revenue standpoint. I mean, it still trades at a market multiple, guy, right?
No, it's not expensive. It's not about that. I mean, this is just it's one of these stocks it becomes very commoditized very quickly. So, valuations are something you don't necessarily need to look at. It just comes down to what type of margins are they seeing with DRAM, which is a lion's share. It's 80% of the revenue is DRAM and the rest is NAND. So if you see robust DRAM revenues and margins, okay, then, but the question is, are you going to see it? Your point is well taken, though. I mean, they have to say something pretty extraordinary, I think, to continue this move. I think what's likely to happen is we have a back and fill to the June prior all-time high, which was probably about 142 or thereabouts.
Yeah. To your point about margins, I mean, it is a supply-demand situation. Obviously, this memory has to go into these servers that go into the data centers and a lot, yada, yada, yada. But we've seen this before. If you want to go to a 5-year really quickly, there's look at that. I mean, the stock has the ability just to actually get creamed. I wouldn't buy this with your money, but well, your money. I mean, we're good, you and me. We don't have like a current account deficit one way or another. You know what I mean? Like we're good. It's a hard one, man. I mean, like
Amanda's telling me something else here. I love when she just said Mike Run again. Oh, there you go. Sorry.
Mike. I mean, I can't be of help here. I just feel like the magnitude of the beat and what's your level? 142?
Yeah. And if I'm wrong, listen, I mean, I'm fucking wrong. Ooh, did I say that all the time? Yeah.
You're fine. I think you're a little hard on yourself. And
no, I don't think so. I think you have to be very self-aware.
The F word insinuates that you're really hard on yourself. But I don't think you should be that hard.
Like that movie when the guy gets the whip and hits himself and then puts the thing on his leg. And remember that? That was one of the Tom Hanks movies, Da Vinci Code.
I don't. Well, that's the priest. That was in the beginning of the movie.
Yeah.
That, you know what they call that? They call that, what do they call those things? That like what's that? No, they don't. He called it. Bill said it, exorcism. So they basically it was like they're torturing themselves on purpose to remind them that they are something.
Self-flagellation.
Was that what did Jacob do that? No, there's another word for
it. What it's called.
What do they call the device that they put around their leg? And you know who that actor was? A good actor. He was the guy who was in Bethany, but something. He was in Beautiful Mind. He was the guy. Little spoiler alert with a bit. We already spoiled. No, we already spoiled the Sixth Sense. You know what I mean? Like everyone knows. I mean, at this point.
When do we do Sixth Sense? I haven't talked about.
Nate Bargatze has a joke where he's like, is about like women who are willing to give their husbands a silent treatment. And he said 25 years ago, we were more willing to believe that his wife ignored him for a full year as opposed to him being dead. Like it's a funny joke. I mean, that's funny. So
I guess enough time has passed.
So if you hadn't seen it, sorry, that's Nate's joke. But then the same thing goes for A Beautiful Mind. I mean, Russell Crowe, he's got this beautiful mind. He's doing all this thing. He's at Princeton. He's got this guy he's talking to, but the guy doesn't exist. Exist. Paul Bethany, who he is married to, and you're a huge fan of her, Jennifer Connolly.
No kidding.
Yes. Paul Bethany married to Jennifer Connelly, who was in the Maverick movie.
Maverick. Yeah, sure.
Yes. Which, did you like the fact that in the first movie, remember they made a joke about
reference to the admiral's daughter.
Yeah, and that was
and she is the admiral's daughter. They tied it together for you. I like when they put a bow on things. It makes it neat because I like those things.
Should we put a bow? Amanda would like us to put a bow.
By the way, Amanda's great. Yeah, let's do it.
All right. So, Guy, you're not with me tomorrow on the
No, I'm going to North Carolina, Wilmington specifically.
And is it in your mind?
I'm going to Carolina. And if the James Taylor song was just Carolina, not North or South, he didn't want to pick one.
Offend one of them.
I'm going to Carolina.
Raleigh, North Carolina, with my oldest daughter Alexandra. It was late April. It was early May. It was May 10th, and we were in Raleigh, and we were going to see Pearl Jam. And Eddie Vedder, he did a little Carolina in my mind. He just kind of inserted that. I can't remember what song. He just inserted in that. And the people, you do it for the locals. You know what I mean? Like, and then you get
big stuff, Jersey stash. Sure.
Yeah, Springsteen does it all the time. You know what I mean?
Like, that's why if you're paying attention.
I miss Bruce. Where's Bruce?
Is Bill playing tonight, by the way?
Where is Billy Hockman? At Billy Hockman. You're going to be at the Greenwich Comedy Club. He's going to be on. If it's Tuesday, he's on at 9:30. Go check him out. If you live here in New York, he's a tall ginger. He's got a nice little ginger beard. He's a ginger. He's got red head. Red hair? What do you want from me? Okay. He thinks he doesn't have red hair. I am convinced. Go to his Instagram, follow him. He's at Billy Hockman. He's got some great stuff on there. And then go check him out at the Greenwich Comedy Club. It's really fun. It's on McDougal Street.
Yes.
And you know what you could do? And I did this with him. I went one night earlier in the year.
Don't heckle him, though. He doesn't do well with that.
I didn't heckle him. And after the show, we went to next door to Danino's, and we had pizza. We had pizza and beer, Guy, which is just a great combination.
That's right up my alley with your mates, with your lads.
Did you have brewskis with your favorite comic in the Village? All right. Thank you, everyone. Thank you.